Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Closure Show. As always, Scott Carson, jacked up to be with you today. Hopefully, you had a great Memorial Day weekend out rocking and rolling along in the sun. Well, I've got a very special guest joining us from out in sunny, warm Arizona. Uh, you guys have heard us talk about affordable housing as a big thing. You know, we've had different community members here in Texas and other folks talk about it. But one thing we're always funny, we've struggle to get is somebody on here to talk about mobile home investing and get to talk about how that is. I really think is that we have such a huge need for that across the country. Now, you guys have seen me break down tapes and talk about, hey, sometimes you want to get rid of mobile home stuff off, especially if it's out in rural and trashed out stuff like that. Not the greatest piece of investment to buy, especially if you follow the number one rule of note investing: never buy a note you don't want to end up owning, right? But today's special guest is not only a huge advocate of affordable housing, he is living and breathing on a day in, day out basis, from the sales of mobile homes to structuring creative financing and seller financing for mobile homes, but also talking about his education side and stuff like that. We're talking about Alden Guajardo. Alden, how's it going today, buddy? Thanks for joining us here on the Nut Closure Show today.
Hey, that was a warm introduction. Thank you so much. Happy to be here. Prolific, out in note investments, being on this show. So thanks for the opportunity today.
Yeah, no problem, man. No problem. So let's talk about before we get into more of the nuts and bolts, kind of where you're at, Drew, but what kind of has driven that passion for affordable housing for you?
It's a huge need now more than ever. But about 8 years ago, when we started in the business, I partnered with my father, who's a longtime real estate investor, bottom up construction, wholesale, fix and flip, you name it. And through the environments of in the communities of like Arizona Real Estate Investors Association and others, we found there to be an opportunity in an adjacent strategy of what people were doing. And a lot of individuals are buying mobile homes and selling them for transport to other states, other institutions that own mobile home parks. And that came with a lot of hardship of, the capital it took to transport it, the permits needed in order to do so, all the above, where we saw a modified program of what other people were operating in, but not so much capitalizing on a fix and flip strategy on manufactured housing on leased land in the park, not moving the home and things of that nature. And as we started to explore and cultivate the market, we saw how much of a huge need it was, not only here in Arizona, but as the years have unfolded nationwide. Affordable housing is such a huge need. So that's kind of how we fell into the business. We saw other individuals operating, making profit, and our modification of that strategy created, unique problems and unique opportunities that not a whole lot of people were delving into because of the negative connotation of manufactured housing. So as we started fix and flipping, we didn't have all that much success in exiting with other banks and private institutions. You can't just go down to a Wells Fargo and get a loan on a manufactured home. Unfortunately, you would think that were the case, but that's not so much an availability, unfortunately. So as we had hardships, these unique hardships in fix and flip strategy of manufactured housing, we found the creative exit via seller carry finance. And as we started doing that, each plateau of business comes with its unique challenges and things of that nature. So, we thought we had it all figured out. Now, seller financing started doing a dumb amount of transactions, getting real velocity at that point, which created the problem of burying money in great cash flowing assets, but you can't go out and do it all over again. So we see just a vast amount of opportunity in front of us at that time, 3, 4, 5 years ago. I had to get nimble in the note investment strategy of how to buy a note, properly sell a note, how to originate a note, why use a mortgage officer, why use underwriting, and cultivate that. So we're gaining velocity in the fix and flip, seller finance, now cultivating a bank quality note, and the rest is kind of history. So over the past 8 years, we've done about 300 transactions, about $10 million in personal property manufactured housing. And just to preface, that's all here in the Arizona market. You mentioned you don't want to buy a home in the boonies. right? At the end of the day, you don't want to buy something that you don't want to end up owning. Well, these homes are in institutionally owned communities. We've learned to cultivate those relationships, provide a quality home and a quality community in a desirable area with an underwritten client. So that's how we started, kind of started to cultivate throughout the business. And now we raise private money for the notes that we originate because we have so much opportunity in front of us, Scott, here in the Valley, that we have to ultimately get nimble, raise money either for a 1 year term or 20, on the note, either hypothecated or they buy a whole note. And that goes into the whole realm of note education. Because of the vast amount of velocity we're being chefed here in the Arizona market, one of the most dynamic markets in the nation, with not a whole lot of natural disaster risks, not a whole lot of fluctuating insurance needs like a Florida market potentially, and people are still kind of moving here. So I said before, now is a better time more than ever because of the affordability crisis. Average purchase prices of single family property are $460,000. Average income 60,000. That doesn't so much break out. And then with hardships in multifamily, that creates unaffordable rental rate. The num
Whoa,
the
slow down there. Slow
list
down there,
goes on.
horses. Slow down there. You're doing a great job. I love you, but you're hitting a lot of things here. Let's take it back a step here. Because
Sure,
you're
sure.
covering a lot of great nuggets, and I completely agree with everything you're saying. Okay. But for those that are listening out there, those that may not speak the same language you and I speak all day long, let's take it down a little bit there. So yes, I'll give you a little bit of my background. I used to work for Palm Harbor Homes back in the day for a while, actually. So
Great.
been very, very passionate about affordable housing. And you're exactly right. It's very unaffordable for most people to buy. And I think especially when you start looking at folks coming out of school and first time homeowners, they're getting priced out of that starter home, and I think a lot of people think people are happy to get in a home, affordable housing, but a lot of people come in, oh, I want to buy that dream home because of everything I see on TikTok and Instagram. Well, that's not the way. You're supposed to start somewhere out, and it's better to have something you can build equity in, something you can get
Absolutely.
into versus paying rent that's not going to get right now. Of course, in a mobile home complex, you're paying a little bit of land rental, but you're also paying for a house to call your home. I mean, like a lot of great amenities. It's like I could compare a lot of the great mobile home parks out here are like living in nice housing complexes, pools and community centers and great neighbors, right? Just because they can't afford as much doesn't mean they're bad people. In a lot of
Completely
cases,
agree.
oftentimes happier people because they don't have more money, more problems, right?
You said it great. At the end of the day, it's a condominium style living,
Right.
with some shared amenities. They don't have to worry about a shared wall or a third floor apartment complex. Those come with their challenges. If they want a red door, they own the house. They can have a red door, they can make it a home. A lot of these parks have school pickup and drop off, where the alternative is an apartment, condominium style solution. And to even qualify for like a condo right now in this Arizona market is pretty tough. And the options aren't all that plentiful for the affordability that someone's trying to match. So, where do they go nowadays? It's truly a state of emergency. That they literally elected it as a state of emergency. And you see these multifamily complexes try to go out and provide for the need for doors. But at that point, with labor and material, it's already out of the affordability before they even build the property.
Right. Well, but then you also run into what we see happening right now. You have a lot of multifamily complexes have sold the last 3 to 5 years that are struggling to get by because investors over finance the property, bought them at 90, 95 cents on the dollar, and then finance it with private capital. I've got a friend who's in 20 different apartment syndications and he's not getting paid on 19 of them. You know what I
Tough.
mean? It's
Yeah.
tough. And that's what I like about what you're doing is that it's kind of like I call it a tripod, kind of like you could say. You remember those, you've got three tripods there. One, the selling of these homes in affordability and helping people get finance, those that can't finance as traditional. Because it's like you said, now Wells Fargo used to be a big financier of mobile homes, but they bowed out of it about I don't know, about 15 years ago. There's a lot limited aspect in getting financed on stuff like that. What is it? What's the biggest one? Is it
I would say 21st
Oh
mortgage.
yeah, 21st
Probably
mortgage,
the
yeah,
largest.
exactly. Is one of the biggest ones out there for sure, and there's a couple other smaller ones out there. But let's talk about look, how does it what are some of the differences you see in somebody financing a mobile home with 21st mortgage versus a three-bedroom, two-bath home? Are we seeing higher interest rates, bigger down payments? What are you kind of seeing? Is that so we can give people an apples to apples kind of comparison?
Great question. Yeah. So, not every lender is going to lend on personal property chattel mortgages, right? Chattel manufactured housing, personal property, and those rates are anywhere from like I've heard as low as 9% to like 20%, depending on the market and things of that nature. The credit criteria, their ability to repay, the case specific year manufactured on the home has its implications. Some lenders don't work with some ownerships of communities, as an end user to try and navigate that when you can just go to Wells Fargo and get a loan for a single family property. It's like virtually a polar opposite environment.
Well, but I would maybe go against it a little bit because most of the banks you've got to have great credit to get financing. If you don't have good credit,
Absolutely.
660 or greater, you're not getting financed in a lot of cases, and that's not the case all the time with mobile homes. Is that correct?
They offer some reduced credit environments. It just depends on their overall financial well-being. Obviously, stellar credit and stuff is kind of the assumed environment for residential purchases.
Right.
These are a little bit less than qualified for a single family purchase, but actually fit great for manufactured housing, because of price point, and things of that nature. But when someone doesn't qualify for a third party lender, say in manufactured housing, that creates the opportunity, and the bell rings there. you
That's
know
what I'm getting at. There's an opportunity for folks. Not every manufactured home company is going to allow that, or they don't necessarily want to do that. When I worked at Palm Harbor, they wouldn't carry financing and a lot
Right.
of stuff. But I think this is where you are feeling that you've seen that gap and being able to say, well, if somebody can come in with some down payment, because we all know a lot of cash buyers or people that are struggling are used to having to come with bigger down payments in a lot of cases. And let's talk about that. Besides you selling them, let's talk about kind of that aspect. Okay, you see an opportunity and you're financing that.
So where hardship comes, presents opportunity, in a highly misunderstood, undervalued, and undercapitalized environment, it creates a truly institutional play in the paper on manufactured housing. And we originate through seller carry finance. So currently we don't do any third-party transactions. It's all homes that we control. But that allows us our availability to where a national lender probably wouldn't finance because of either the ownership of the park or just some case specific documents that the buyer needed. They can really afford to pay as they go through our underwriting, and it was just a ding because of a medical bill or whatever it may be. That stuff happens a lot. And there's virtually no other options for an individual coming into a situation where they've found a house they've fallen in love with and they just can't get secured financing. So that's where we've stepped in and started originating seller carry programs, where, a lot of individuals that may even be watching here today, it creates a challenge because there's not all that huge resale market for the paper itself unless you've cultivated a brand. So it's a hardship to navigate, but to be able to properly package everything together and know that the house was quality and maybe the bank didn't finance it just because of the one specific tax document or whatever it may be, that creates a branded, double underwritten asset at a double digit yield. Well, what were those yields? Those were 9 to 20%. I seller finance here in Arizona at 14, and you could buy a note potentially for the face rate and participate in that transaction, being the bank. Where in the alternative of a single family note, the yields aren't all that much high. You got to maybe get a discount, in order to get a satisfactory higher yield on your return. So as that's cultivated in the problem, when I just really wanted to exit my fix and flip at the end of the day, now to create this whole back end strategy and know that we can find either an IRA or investor or a non-accredited person who wants to buy a note just for personal investment, those are all areas of conversation that have been cultivated from that initial problem.
Sure.
Just trying to exit the home in a fix and flip strategy, and now we're participating as the bank, making money outside landlord and tenant complications. And Jenny May, who bought the house, cried at closing. You not only got a feel good investment strategy out in the market, creating an owner in a time when it's needed most, when they couldn't qualify for a single family property and they have kids or whatever it may be. And you're cash flowing at say 90,000 bucks, $1,000 a month. That just now starts to open the eyes, I
Yeah.
think, of a lot of individuals that were like, hey, mobile homes, you can just pick it up on a flatbed and get it out, out of there. Well, that's a travesty, I think, for not only the capital appetite into the environment, meeting the need, but just the misunderstanding
Yeah.
and common misconception. Trailer Park Boys came out on Netflix, and that didn't help, the environment by any means. But
Well,
this is a new day and age. I want
yeah.
your opinion is on that.
Well, I think here's the thing. I think modular built is just as good as stick built. The ability to build a home in a factory in pieces and have it delivered in pieces and put together faster, I think makes more sense than anything else. The cost dollar average to build a regular home versus a modular built or a manufactured home, no comparison, because modular is going to beat you, be so much cheaper in a lot of cases. Now, obviously the biggest expense for a lot of folks is that land and utilities and stuff like that. But if you're going into a park, you've got on-site management, you already got on-site utilities, and let's face it, how many times has park managers woken up in a mobile home you've been moving out of the park? It doesn't happen, right? It doesn't happen. The only way we do it if it was like in say like I remember the famous marketing piece that Palm Harbor Homes used to use with the Hurricane Adam back in Florida or Aaron or something like that, where a hurricane went through a mobile park community, trashed everything except the Palm Harbor home sitting up there. I'm like, okay, yes, you had a lot of shit boxes built back in the day, or stick boxes, but that's not the way that these things are built now. They're built more and more like a regular home, good quality craftsmanship, and you've got somebody who's going to take care of it. Pride of ownership is one of the most important things out there too. It's not just it's not the little RV, in the back of a pickup parked with four flat tires on the side of the road. You know what I mean?
No, 100%. These are much more structurally sound and more stable, than ever. I think it was after 1978 that they changed a lot of the building codes, lead-based paint, asbestos and stuff like that.
Aluminum, getting rid of aluminum wiring, which is pretty common back in the day. Yeah.
So the common connotation towards a non-stable, falling apart home, a lot of these times, these homes have been here for 50 years in their current location and never moved once. Probably 99% of the time, depending on what market and stuff like that. Well, those are the homes that we're picking up, because we see the opportunity and see a stable environment. It needs rehab. It's sat there for 50 years. What house is not going to need rehab after 50 years? That's just, out of the negative connotation is where it creates the opportunity, because there hasn't been players in the marketplace to fix and flip these homes when the parks don't really want anything to do with it. What do they want? They want the park rent
Yeah.
at the end of the day. And when you're talking to everyone and their mother in single family who's fix and flipping houses, there's not a scarcity of people to fix and flip houses. But in manufactured housing, just people haven't delved into the market because of their hardship in the exit, at the end of the day. And that just creates so many more opportunities here in the Valley. 300,000 manufactured homes here in the Valley, all being financed, insurance policies, warranties, from institutional players. And the most of the parks here, I think in the nation, actually, I saw the other day, were built in the 70s.
Yeah.
So when they built the parks, they brought in a gang of mobile homes And what year were those homes? 1975, 1980. They flooded the park with inventory to get their lot rent. And now, 50 years later, those 1975s and 1980s units are still sitting in their same condition because no one came in and fixed and flipped a strategy. That's a 250,000 manufactured homes that are waiting for an institutional player to come in and facelift or sell, seller, carry, finance, and all the above. Where the alternative, even say for the mobile home parks, what's their replacement cost? By the time they try and buy a unit new here in the valley from a brand new manufacturer, they got $120,000 purchase. They still got 20,000 in transport and setup. That's 150,000 plus commission and time on market. It took them a year to do it. That really starts to create all kinds of trickle problems for the institutions that own these mobile home parks that may have bought a 1970s constructed community, and now they got influx of needing to rehab inventory. That just goes on to show the massive available opportunities because of the negative connotation towards the environment and the non-structured exit strategy. It's a real diamond in the rough, I believe, opportunity to try and navigate not only the fix and flip and sale of the home, but also build a brand and awareness that this is a bank quality note, still the same note and ability to repay as a SFR, maybe sometimes even higher, sometimes between the comparison of the non-evictions and non-criminal background and things of that nature that some of the communities require upon the underwriting of the note. Where we're not just the lender, we're not just fix and flipping the houses. Now we've got an umbrella brand to be able to run a vast amount of deal flow because of the 1970s environment.
Right.
The data points really just start to pick out.
Yeah. So your model, so to clarify, you're going around to different parks, if I'm understanding what you're saying. You're going around different parks there in Arizona and finding homes that need to be remodeled. You're able to pick those up relatively cheap, I imagine, because a lot of homes want, parks that take them over ownership want to get, you just want to get them off their books in a lot of cases, so they're often willing to sell them at a discount price. You're going and then rehabbing them, fresh floors, new appliances. I've always loved the fact that mobile home communities, mobile home builders created the PEC system. You know what I mean? The plumbing system that is now being used in traditional build outs a
I
lot of
didn't even
times.
know that.
Oh yeah, yeah, yeah. That whole plastic stuff under the sink there, that was started by mobile homes, and we're seeing that now in newer built homes all over the world because they realize it's a lot more flexible product versus especially in colder environments where the PVC will crack, that will stretch in a lot of cases. So you're going out, find these homes, fixing them, and then offering owner financing to folks out there looking for homes. Is that correct? Besides you selling your own stuff, or is the selling of the homes strictly the ones that you're finding in the parks they're held?
Yeah, exactly. So we operate as the largest independent licensed manufactured home dealer in Arizona, buying and flipping. We have some listings, we operate as a regular dealer, and
Sure.
that brings unique deal flow that helps with the relationship with the communities,
Yeah.
and things of that nature. But yeah, it's based as a fix and flip strategy. We're buying deferred maintenance, manufactured housing, and replacing PECs and checking electrical. We're selling it to Jenny May on terms, and properly underwriting the note. And we do that on a grand scale in say like 50 different parks here in the local market of Arizona: Mesa, Tempe, Glendale,
Nice.
Phoenix, Apache Junction. We have about 25 homes in inventory right now, that are immediately available, and some in rehab. So that's kind of the base, of what we do.
What do you see as kind of the base remodel on a house? Now, obviously, we know it's all different in a lot of cases, but what do you see on a home that was built in 78, late 70s, early 80s as the biggest upgrade needed in a lot of cases?
You know,
Roofing, exterior, plumbing, what do you see? And how does that cost compare kind of towards a traditional single family home in a lot of cases?
Yeah, so a lot of it's, windows, plumbing, electrical, classic stuff just to be in adjacence with residential real estate at the end of the day. The benefit is a lot of the times you're not needing to pull permits or add additional square footage, or, to get permits for electrical and stuff like that. So kind of highly unique. It speeds up the process.
Yeah.
You're obviously encouraged to use licensed and knowledgeable individuals at the end of the day, so you don't have any houses burned down. And we're blessed to not ever have had that issue
I'm
of,
knocking on some wood for you there real
yeah.
fast. Yeah.
That those are just common things that we do. We've gone as far as put new siding on homes, new T111 where it looks we almost like remanufacture units sometimes, from the roof to the siding to the windows to the electrical. You can obviously overpay and overestimate on your
Right.
rehab for, what your exit is at the end of the day. So we're always trying to price that in ultimately, because remember, we're here for the affordability hedge,
Yeah.
right? So we've found once properties kind of start to inch over 100, it really needs to be a four-bedroom, and 125, 130 is really kind of the benchmark of our top end price point. Why is that?
In
Because
your in your market,
correct.
specifically to your market out there. Yeah, it'll vary a little bit different in other areas, but so yeah, that 3 bedroom, 2 bath, 4 bedroom is harder to find though too, right?
Absolutely. Definitely few and far between. Their alternative for SFR, single family residence, is 450,000 for the same square footage. So, just creates the challenge. That benchmark, we see homes sell for higher, some
Yeah.
newer homes and stuff like that. But really, for the end users, palatability and affordability on the price point, it's really like 80 to 125, because that's what either matches or beats market rent. So once they buy that house with lot rent, the home payment, insurance, taxes, if they can match or beat market rent, that's really where the win is for the buyer, but also the stability for the note holder. Because if they go rent for a 3.2, that's 2,200 here in the valley in a desirable area, major market. They match or beat that in a 3.2 and they own it. It is where the benchmark is for the interest rate. So average rents here in the valley, lot rent, in communities is like 800 to 1,000. So you have about $1,000 margin monthly for the end user borrower, to where they can't go anywhere else for cheaper. Now they own a rehabbed house with electrical and plumbing and new windows and stuff like that. So that's kind of how it's all boiling down to the entry of the acquisition. We buy anywhere from $500 to 80,000,
Yeah.
depending on the rehab. Some need more rehab than others. Obviously, a $500 purchase is probably going to need,
A lot more,
40,000
right? Yeah. It's like get
in
this off my
rehab.
book.
But
Yeah.
that's kind of how we look at the model, from purchase to rehab, and how that compares to SFR.
Yeah, I know it makes sense a lot. And then you're kind of sticking to that point with lot rent and then PITI,
Exactly.
still falling at with that below 50%, 40% of what their monthly, take home pay is roughly, give or take a
Yeah,
little bit.
so we normally match like a FHA requirement. And I think it's like, they'll go up to late
Right.
50%, something
Yeah.
like that, 58%. Don't quote me, but that's why we use a third party underwriter, to verify that information. And we're not so much doing that in-house. We have some people that don't meet the criteria because of case specific situations, and we'll evaluate that on a case by case basis, ultimately to make sure that we're providing a hedge and mitigated risk, not only for us, but also the capital investor, and, limiting liability, when we're seller carry financing.
Now, the fact that you've owner financed a chunk of these, have you had any defaults on any of the stuff? Um,
Yes. So you do enough business, you're bound to get a default. We've been extremely blessed because the communities themselves have forced us to kind of increase our requirements. As the institutions now buy these mobile home parks, they increase their requirements, a credit criteria, no evictions, no open bankruptcies, verifiable income. And then we go through our secondary underwriting, for debt to income ratios, make sure they're not on the lam, stuff like that. But the default rate has has been extremely low over the past 8 years. So we've done it a handful of times where we've had to repossess, the buyer borrower put their head in the sand, and we couldn't communicate with them, didn't we couldn't do a workout for their first payment. Those situations happen.
Yeah, of
But
course.
it's like a 1.5, 2% default rate at the top, 2%,
Yeah, that's
super,
phenomenal. Very
super
phenomenal.
great.
Very, very low because when somebody's a lot of times people get into, they're very grateful they do everything they can to
Absolutely.
avoid that because they have no place to go really, out there. And then with these loans, if you did have to foreclose or evict, it's relatively fast because you're in Arizona there, correct?
Great point. So, in comparison of a foreclosure process, here in Arizona, it is a trustee deed state. So, that could take 90 days, and then you got your 60 days of cure. I'm relatively familiar with the SFR foreclosure process. I'm even more, in depth with the manufactured housing. Why? Because it's like a repossession. It's considered a repossessed unit because it's personal property and an eviction process. A lot of the times, if someone's going behind on their home payment, they're going behind with the park as well, if that's, in that realm of environment. And it's like a 40-day process, from non-payment to, 2 weeks later, they get a notice of non-payment. 2 weeks after that, they get a pay or quit. And then 10 days after that, they're having a constable at the house with a writ of restitution, retitle the property, and ultimately, I think it's like a week they have to get their stuff out of the home. They have to schedule it at that point, and then we, repaint the house, do a move in, move out like a landlord and tenant program, and remarket that home for sale and either mitigate loss or earn additional profit, depending on how the deal closed out, how long it took us to repossess the unit, what kind of market we're in right now. Pretty hot for affordable housing. Uh, but with that mitigation of the 40-day period and non-availability for them to keep stewing on losing a house or whatever over 6 months, they could do a lot of damage over that period of time. Where an alternative, they don't really have all that much time to really stew in the house and stuff like that. Preface here, we're not in the business of taking people's houses back by any means, fully aware of the situation, but we have recourse, right? This is
Yep.
an investment. We're making a capital commitment, investing in the terms of the contract. For an individual, if they stop them, if they fail to pay their first payment confidentially, we'll probably throw that on the back of the loan or something of that nature to try and work out the situation. Why? Because
Yep.
we're in it for the payment and the performance of the
Sure.
paper at the end of the day. But we have recourse, right? We're not going to let it go by the wayside and lose on a tangible asset. The
Yep.
home's there. We're going to get capital back. It's just what, to what fashion that is speculative to the environment, the market, and things of
Yep.
that nature. We've made more money on repossessions. We've lost some small dollars on re-exiting, but we end up reseller financing and picking it back up on the amortization schedule, which is unique about not just being the lender, we're also the dealer, and have an accredited investment fund, all kind of in the same realm.
Right. Well, that's the thing I wanted to bring to for those folks out there listening, and you've got some money sitting in an IRA, you're looking to put it to work. Folks, what's kind of your ballpark investment that you're looking for from investors to purchase one of your guys' notes at? Is it 50 grand? Is it 100 grand? Kind of ballpark in there. I
Yeah,
mean, I think you mentioned, I think you had your deal of the day was like 90 grand. Was it a note for 98,000 this morning? I think if I saw it correctly, right?
yeah, yeah. So I went live this morning, tagged you on Facebook. So we did a feature note on there. I'm just going to look at that here real quick. So on average, an average purchase price of a manufactured home's like 80K. We're taking 10% down, so it's about 70,000 on average. Say 70 to 120 is kind of ballpark of
Yep.
what a note acquisition would look like. Those are 20-year amortization schedules. And just to kind of preface, on the deal of the day that we have currently here in the Mesa market at 98.9, it's sold. The unpaid balance is 93.9. So they put like 5K down and ultimately got their ability to repay at $1,167.67 a month for a 20-year term. And for the yield, you can run that on an amortization schedule and on a calculator and figure that out. But that's a great non-accredited strategy for an investor to buy a first lien performing asset at $1,000 a month for 90K, to try and replicate that in another strategy or in the stock market as an income-oriented investment strategy. It's almost non-existent. You may be able to find it, but it's really tough. You may have to get a discount on the note or whatever, but that's kind of some
Well,
averages.
it's about a 15.5 yield based on 1167 a month without servicing costs figured in there and stuff
Great
like that.
yield.
It's great yield. I mean, that's why I love the note business. When what they say is, in a lot of cases, when your risk goes up, your ROI goes down. But when our risk goes down, our ROI goes dramatically up in a lot of cases. That's why it pays to be the bank. We've been buying non-performing notes since 2008, and buying stuff at a discount and then rehabbing the borrower, or rehabbing the property. We end up taking the property back and then turning it in performing paper, or taking the distressed borrowers and getting them back on track again for performing paper. So the yields are definitely possible. That's why I love the note business. Whether you're originating or you're buying them, there's a lot of opportunity out there. Yeah, to beat the heck out of the stock market, and it's a lot more. It's a tangible, secure asset that is this one, like this note your deal today, pays when pay for 20 years. If the borrower stops paying, you're going to go through that process to take the property back, evict, and then start it all over again. And then the property is going to be worth more with 2, 3 years of appreciation on it, right?
Yeah, it could be. And, people say mobile homes don't appreciate. Well, I'm here to tell you that that's not the case.
True,
Mobile
so
homes
true.
have actually appreciated. I was buying and selling homes at 30, 40,000, 5 years ago. Those homes are now 100, 120,000, so mobile homes do appreciate. It's obviously
Yeah,
market contingent,
yeah,
at the end of the day. But just that's a great point in itself. And the fact that how notes are so nimble. This is a note investment strategy. It just happens to become in manufactured housing, which is a highly unique, combination. But knowing how to reperform an asset, knowing how to buy a performing, and if it goes non-performing, how to reperform that, how to buy, non-performing, and go through all those notes is so nimble. It's amazing. The amount of ways a note can be structured. You could sell a hypothecation for a 1 year term at 10%. You could sell a note partial later on, almost like a cash out refi. You're a note investment educator, so I'm sure a lot of your listeners are more attuned to the environment, but not a lot of people even know you can buy a mortgage and what you can do with that, at the end of the day. And I'm just blessed to even be here, blessed to have the education that I do, blessed to meet contacts at Diversified Mortgage Expo we were talking about, Noteworthy, Note Expo, all the above. It's really eye-opening now more than ever because of the hardships in single family pricing, interest rates, you see in bloodshed and multifamily syndications.
yeah.
We saw $1 trillion get wiped off the stock market and then brought back on the stock market. That could make your hair fall out at the
Yeah.
end of the day.
Yeah. So Aldo, I love it. And part of the thing that I really like is I really love folks that embrace the marketing side of their business. And you have done a really great job embracing that aspect of it. And honestly, truly, it's a rarity in the note space. I think not many people understand how to market their note business, right? And it's not harder because you have a lot of opportunity. You got deals, you got tapes, you got assets, and I love what you're doing. When I saw what you were doing with your uh, the mailbox money. I'm sorry, I'm probably quoting that wrong. Let me pull it up here. Your mobile mailbox money. My apology. That's your media and education side of stuff. I love what you're doing. Can you talk a little about how the impact of doing that stuff has helped your business grow?
Yeah, man, you can't afford to do it. You can't afford not to do it, kind of thing. Nobody wants to be on podcasts all the time and posting on social media. It's really kind of a job, but it pays in spades. I remember we were at Paper Source when it was at the Tuscany in 2022, and I was
That
like,
the casino that God forgot about.
Yeah, it was a great time, but they
Sure.
ended up, didn't end up coming around and doing more conventions. I think they're talking about doing more. Anyway, long story short, I was in the room, young. I think it was 3, 4 years ago,
Yeah.
and I was young. I was trying to meet people, was finding it a challenge because I was young and people didn't so much want to talk to me. How do I touch this whole room, and it's online at the end of the day. So I created mobile mailbox money at the event. I created a Facebook page, started doing videos at the event, and that's really blossomed in that single aspect of at conferences with social media and YouTube presence with adjacent branding of where I'm at, what conference it is. And over the past 5 years, we've cultivated a podcast. Now we do a mastermind every 2 weeks, just free, just to keep growing the opportunities. And that's on Zoom at 12 o'clock Mountain Time on Thursdays. But also, going to these different conferences and bringing cameras and lights. We end up having a booth half the time and trade for credit for service. But, getting people to come by and finally talk to me and understand that I know what I'm talking about, having great conversation, and it all look really professional with lights and cameras, action, all the above. So that's really been literally life changing. The amount I get like 50,000 views a month on my Facebook, and that number continues to climb. It's not anything crazy, but listen, that's 50,000 people I wasn't talking to before or never ever would have talked to in the very beginning. And even just being here on the Scott Carson Note Closers podcast, I take full advantage at any given time of co-promotion. We went live this morning and I tagged you. I'm not sure if you saw that.
Yeah.
But all of that stuff, it's definitely work at the end of the day. But if you're doing notes and you're raising money and you're failing to meet more people or raise more money, this is how it's done
Yeah.
nowadays. It's
Yeah.
not the yellow pages. It's not having the triple A in front of your business name to be at the top of the book. It's adjacent branding and letting people get to know, like, and trust you online and surf the stuff that you have at their leisure. Where before it would have had to be like this. We had to schedule a podcast or schedule a conference call, and sometimes that doesn't so much work out. You got conflicting schedules, everybody's busy. But if you've got 590 videos online of walkthrough videos, testimonials, adjacent branding, the proof just starts to stack up.
Well, that's the thing too. I mean, we've closed thousands of deals and shared, and people love the case studies. We're breaking down tapes of deals,
Love
and
it.
just sharing that knowledge is a great thing. I mean, and you're so right. There are two kind of thoughts, right? And I had a conversation with somebody who's been around for 30 years too. He's like, "Well, Scott, I'm from the age that we just don't share. We have to hide everything. Your age group is from share everything. I just don't understand that." And I'm like, "Well, you can either share it or people are going to go find it from somebody else who is sharing it. You can either adapt and overcome." And that's the thing I always cracked up about some of these older conference stuff like that is like there's that kind of, and we call it in like realtors, the baby blue hairs, the people that are old fashioned, they're used to doing the whole thing. I got to do it in my HPB 10B2 to calculate that, you know, um, you know, I gotta, gotta do it one way. It's not the right way of doing it. Well, it's new. It's the 21st century, and either you're going to get on the track or you're going to get run over by the train. As I say, Scotty's giving her all she's got, Captain, to bring you to the 21st century. And I love it from somebody else who's doing an amazing job out there. And you've got mobile. What's the best website for folks to go out, check your deals, check with the fund and stuff like that for you? Because you've got a accredited fund 506C that you've put together to help fund the
Yeah.
stuff with IRAs and accredited investors too, right, Alden?
Yeah, absolutely. So, you could buy a note today at mobilemailboxmoney.com. If you're curious about just viewing the homes that are like available and the validity of like what inventory looks like, stuff like that, you could go to our dealer website, winmobilehomes.com. Or if you find yourself blessed to call yourself an accredited investor, I have a once in a lifetime opportunity for you to earn a 10% return for a 1 year term in Silvercrest Opportunity Fund performing debt. Okay, that's a bank quality return in a Warren Buffett investment strategy. 1 year term for 10% net or 3 year term for 12% net. That's an income oriented investment strategy. If you don't see something that you like on the website or you're looking for more information, you could call us today at 602-888-CASH. And this is the new day and age of business. At the end
Yep.
of the day, these podcasts, not holding the blue book in your back pocket and not sharing knowledge. I'm here to share. I'm here to provide value and maybe even help you enter into this marketplace. There's a vast amount of opportunity here, not only in Arizona, but also nationwide. And I'm just happy to provide somebody value and even have such a gem-filled conversation with someone that's been in manufactured housing far longer than I have, and sees the opportunity for what it is in the case unique combination of notes and manufactured housing. Scott, you've been a pleasure to share with today. A lot of great information bouncing back and forth. So hopefully maybe you can come on my podcast. Would love to trade swap spots if that works.
I would be honored to be on your podcast for sure, definitely. I think it's one of the best ways. That's part of the reason we stopped traveling so much, stopped going to smaller conferences, is because we were getting more traction with our podcasts and YouTube channel, stuff like that as well. So definitely looking forward to that. Definitely looking, we got to have to meet in person at some point for sure too, Alden.
Yeah.
So guys, you heard it there. The best places to reach out to if you want to get rock and rolling, you've got some lazy assets sitting in an IRA, or if you're credited and you want to do something more, check it out. Check out what he's got going on. Some great stuff. Not somebody who's done one or two deals, but somebody who's doing hundreds of deals, 100 of these mobile home rehabs, refreshes is probably a better way to say it, refresh, rehab, and offering people an opportunity. And I think if we had more people like Alden out there, we wouldn't have such a affordable housing crisis in America. So go out, take some action, everybody. Alden, it's been great to having you, everybody, and we'll see you at the top. Bye.
Bam.
Hey, real estate investors. So you want to dive into the world of note investing, but don't currently have the funds to sign up for an expensive class or a workshop or one-on-one coaching. Well, then you definitely want to check out the biggest bang for your buck in the note world. And that's our WCN membership. It get you an all you can learn access to our class workshop replays, tapes, weekly coaching calls. For $97 a month, it's the biggest bang in the note industry because you get access weekly with me. You can book one-on-one phone calls with me. As we get different tapes in, we'll share them with our members after our one-on-one coaching students get access to us. We share a variety of tools, like I said, replays to the previous workshop, special discount codes to other events that you can take advantage of to help you get more bang out of your dollar every month. We've been investing in notes for over 20 years, and one of my biggest passions is helping note investors, big and small, get started buying notes. Yes, I got started years ago with no money, no savings, and no list, and I love helping people close on their first deal, get their first private funding partner to help them fund more deals and help them both make above average returns. If you're looking for somebody to help you take your note investing from 0 to 60 and want to get started, my WCN membership is a great place to get started. Like I said, we upload lists to it, video training, coaching calls for $97 a month. What can go wrong? The only thing we ask is you hang around for 6 months, and then if you don't like it, you can cancel. But check it out at noteumbrella.com. That's noteumbrella.com. That's our WCN membership. Get looking at assets today. Start putting your fingers on the trigger to pull the trigger on some note deals here before too long. Yes, anybody can buy notes. I don't care your age, your savings, what race, color, whatever it is. Note investing is all about what action you take. And the first action you should take is signing up for our monthly membership at $97 a month. That's noteumbrella.com. You can also access it by going to weclosenotes.com and checking on the monthly membership. But we are here to help you. Scott Carson, the Note Guy. We look forward to seeing you at the top.